Good morning, students. Welcome back to the session on this advanced accounting. So today we are going to continue with our discussion on AS7 first of all. And once we are done with AS7, we will also start with a new standard. In respect of AS7, we were discussing about the combining and segmenting of contracts. Remember? Yeah. And I'm just hoping that all of you remember this concept. All right. So now we will start with one example for this so that we can also sort of revise this quickly and then we'll move further. If all of you can move on to example number 4, page number 1.25 please. Okay. You need to answer this. XYZ Construction Limited, a construction company, undertakes the construction of an industrial complex. It has separate proposals raised for each unit to be constructed in the industrial complex. Since each unit is subject to separate negotiation, he is able to identify the costs and revenues attributable to each unit. Should XYZ Limited treat construction of each unit as a separate construction contract according to AS7? What are your thoughts on this and the reason for the same? Yeah. So now this is for you to answer, and I am now waiting for a response. Quickly. If you can start answering this. Yes. Should this be considered to be separate contracts for each unit, or do you think for this entire complex a single contract should be the right approach in terms of booking of revenue as per AS7? Yes, quickly. If you can answer this. Waiting for a response, quickly. In this scenario, what do you think will be the right approach? Should this be considered to be separate, or should this be considered to be a single contract in terms of revenue recognition? Okay, so Priya is saying separate contracts should be considered for each unit, and Khushi is saying since each unit is subject to separate negotiation, so that's why it will be appropriate to consider separate contracts for each unit. And that's correct. In this case, the revenues, the costs are all separately identified. Yeah. So that's why it will be appropriate to consider revenue recognition of each unit as a separate contract, instead of combining all of these units for the purposes of revenue recognition. That will not be the right approach over here. Okay. Yeah. Now moving further, in relation to the revenue recognition, we have talked about a lot of points, and in the meantime, I have also received some more responses. Let me just see. Ayush, Sanjay, Ridhima, they are all saying this should be a separate contract. No, sorry, Sanjay is saying single contract, Gilbert is saying separate. Sanjay, please try to understand that because we have got the revenues separately, costs separately, so it appears as if the discussions for each and every unit has taken place with the markup in relation to that separate unit. Negotiation has been separate, and the most important aspect is that each and every unit appears to be independent, wherein combining in relation to revenue recognition of all of those units will not really help. That should not really be the area which needs to be considered over here. Fine. Okay, so now we can move on to illustration number 1. Through this illustration, we should be able to recap most of the concepts that we have discussed so far. As regards AS7, we have discussed everything. So today we are just doing a recap by practicing these questions. So you can move on to illustration number 1, page number 1.29, and start solving this on your own. Okay, you need to start solving this, and you can also share your response. Nakul has also shared the response for the previous one. Separate. Sakshi is also saying it should be separate. Very good. A firm of contractors obtained a contract for construction of bridges across River Revti. The following details are available in the records kept for the year ended 31st March X1. Total contract price is given. Work certified for the cost incurred is given. Work not yet certified for the cost incurred is given. Estimated further cost to complete is also given. Progress payment received. What is progress payment received? It's the cash flow. Yeah. Progress payment received is what? That's the cash flow. So will that have any impact on our assessment? We'll have to see. And the amount to be received is 140. Okay. The firm seeks your advice and assistance in the preparation of accounts, keeping in view the requirements of accounting standard number 7. Okay, so we need to consider the principles of accounting standard number 7 over here while answering this. Yeah, and I'm just hoping that you have started solving it. I'll just put down some of the facts for the year ended 31st March X1. The information is available to us. Total contract price. So total contract revenue is 1,000. Yeah. Work certified for the cost incurred and not yet certified. So cost incurred is 605. Cost incurred till date is 605. Out of which certified is 500, not certified is 105. Okay, Ayush I think has already solved this. Very good. Kushi is saying this total foreseeable loss in this contract. Okay, great. Let's see. Estimated further cost to complete will be 495. So that means in the future, 495 cost is estimated. So we have already incurred 605, 495 will be incurred. So the total cost to complete is 1100. Correct? So definitely there is a foreseeable loss of 100. Progress payment received 400, to be received 140. I'll go to this later. Yeah. Now, in this contract, as you rightly mentioned, there's a foreseeable loss. Foreseeable loss means the loss which is sitting in the books right now and pending to be booked, if we follow the percentage completion method. So what do? We need to recognize that foreseeable loss as an expense. So the first working is amount of foreseeable loss. So the cost incurred is 605. Cost to be incurred 495. So this becomes 1100. So the total cost of the contract is 1100. Yeah. Total cost of the contract is 1100. Total cost. Total revenue 1000. Total revenue is 1000. So estimated loss is 100. And this estimated loss is what? This is nothing but the foreseeable loss. So this will have to be recognized in the current year itself. Correct? As we all understand, yeah, this will have to be recognized. Kamal is saying provision for loss is 35, net loss is 100. Okay, great. Now, we need to now check the amount of revenue which needs to be recognized. Correct? So far, if you will see, the cost that we have incurred is 605. Cost that we have incurred is 605. So what is the percentage of work which is completed if we follow the cost method? We'll have to derive this. So if you can all go to this part. So let me just clear this part first of all. Cost incurred divided by total cost. So 605 divided by 1100. What do we get? Can you tell me what do we get? Anushka has answered this. Anushka is saying 55% is the percentage. I think you're saying the percentage of work completed based on total construction cost. Okay, great. So if we have 55% as the work completion, and this is based on cost method. This is based on cost method. Okay. Sakshi is also getting 55%. Now, what is the amount of revenue that we need to recognize? We need to recognize a revenue which is 55% of the total revenue. To be recognized. 55% into 1000. So that will be 550. Alright. So now we have computed the amount of revenue to be recognized. We already know the cost which is available to us in terms of the work completed. Let's now understand the amount which is due from the customers or to the customers. Because when we are looking at the accounting, we'll also be looking at the debtor, yeah, or you can say the customer receivable amounts. Correct? So now, the next thing is amount due from or to customers. So what do we do over here? For this, we will use this formula: contract costs plus the recognized profits minus the recognized losses. Contract costs plus recognized profit less recognized loss minus progress payment received plus progress payment to be received. Progress payment received plus progress payment to be received. So what do we have in terms of the costs which are incurred? 605 plus, there is no profit, in fact it's a loss. And the progress payments which have been received and to be received are given minus 400 minus 140. So what do we get in terms of the amount which is due from the customers or maybe due to the customers? It comes out to 35 lakhs negative. So that means it's the amount due to customers. Amount due to customers will become 35 lakhs. Please remember that every time you write the figures, you should specify whether these are in rupees, lakhs, months. So currently I am not doing that, but you need to take care. Okay. Now, if you look at this 35 lakh is the amount which we have received excess as at 31st March X1. Why we are saying excess? Because in terms of the revenue that we have recognized, yeah, this much amount is excess. This much amount we have received excess. Okay. Therefore, what should we do? Therefore, we should record this amount as, you can say, advance receipt from the customers. It's a kind of liability. Okay, because anyways, the remaining amount will also become due in the next year, which will get adjusted. Correct? Now, this is in terms of the recognition that we are required to do. Other than this, there are certain disclosures which you also need to consider. So let's get on to those disclosures. The disclosures which are required to be considered by us. I'll come to your queries. I can see a couple of similar queries from Manish and Ayush. I will come to your queries. So now I'm moving on to the disclosure part. See, in terms of recognition, measurement, things are completed. Disclosure means only the thing which will go to the notes to accounts. But please also appreciate this point that disclosure will have linkage to what is recognized or measured in the financial statements. So what is required to be disclosed? First, contract revenue. What was the contract revenue? 550. Contract costs, I think this was 605. Correct? The recognized losses, these were 100. Yeah. Progress billings, or you can say progress payments, but it will not be appropriate to call it as payment because it's a receipt. So that's why we are calling it as progress billings. Progress billings are what? 400 plus 140, 540. Okay. Retention. Retention means the amount which is billed but not received from the contract fee. billed but not received from the customer, 140, and the gross amount due to customers. Okay, so now there are few things over which you need some clarity, and I'll just clarify one point. First, I think the biggest confusion that you have is in relation to the percentage condition. Manish is asking and Ayush is asking, sir, how can we recognize revenue for the work which is done but not yet certified? As I told you, there are three methods which can be followed. Cost method, survey method, or the number of labor of hours method. If you are following cost method, then you will go with the actual cost which is incurred. Let's suppose if there is a survey, if on the basis of technical assessment, a particular cost could not get verified, but the cost has been incurred and that is on the project. So why don't we consider that? We should definitely consider that because we are following the cost method. Number one. Number two, as regards some of these disclosures which you would have seen over here, yeah, there is an amount which we have considered equivalent to retention. Now, what does this retention imply? This retention is the retention by the customer. It appears from the question wherein they are saying progress payment to be received is 140. So generally in case of construction contracts, billing will not be done on the basis of what we are recognizing as revenue. No. Billing will be done on the basis of milestones which are achieved. When I'm saying billing means the invoice which is raised to the customer. For the purposes of a revenue recognition, amount will be 550, but it may happen that amount which has been billed to the customer is 540. Because once again, you need to remember this point that revenue recognition has nothing to do with the cash flows as well as invoices raised. So if we raise an invoice today, that doesn't mean revenue can be recognized. Correct? So this much amount has already been raised to the customer. So if this is raised to the customer, but he has not paid 140, what does it mean? Customer has held our money. So it's a retention with the customer. Understood? Yeah. And the most important point which you need to consider over here is the difference between these. This one and this one. Yeah. This clarifies this point that the revenue recognition may not be exactly similar to the invoice which is raised to the customer. Okay. Clear on this? Yeah. So with this, we can just conclude our discussion in relation to AS7, and then I think we can move on to the next standard, AS22. AS 22 is all about deferred taxes. Okay, Priya is clear on this? Kamal, Christina have got few queries. So I would suggest you can just park your queries for some time now, maybe towards the end of the session, please. Let's get started with the standard, and all of your queries in relation to this AS7, we can then discuss maybe towards the end of the session. Fine? Yeah? So let's move on to this topic now. Shivendra is asking, how will this amount due to the customer be shown as creditor? See, it's the money which is received in advance. When you say it should be shown as pre-received income, this is because of the fact that it's pre-received. Something which is received in advance for which invoice has been raised. Yeah, but that has not been fully paid. That's the retention. Clear on this? Okay, so let's move on to AS 22 now, please. All of you, yeah. AS 22 is a very important topic for the purpose of your examination. Plus, this is also practically widely used. Because if you look at any company, application of AS 22 will be there. If I have to compare this to AS7, for example, where would AS7 become applicable? Only in case of contracts. So if the company is not into the construction contract, AS7 will not apply. So that means AS7 doesn't apply to each and every company in a way. But application of AS22 is such which covers almost every entity. Every entity will have to consume this. For example, similar to AS7, sorry, AS10, GP, every company will have property, plant, and equipment. So that's why some of these standards become very, very relevant and very, very practical also. Okay. Now, this AS22 covers certain concepts which may be completely new to all of you. So that's why there are few terms which are important for the purpose of your understanding. After understanding those terms, we will get on to the purpose of the standard. We'll try to understand what the standard tries to convey. So I'm just using some of the terms which are given in the standard. Okay, so if you can go to page number 1.108. There is first term which is called as accounting profit or loss or accounting income or loss. We all understand P&L, yeah? Statement of P&L. We all understand. So what does this cover? Revenue less expenses are not just listed out each and every item, revenue or expenses, yeah. And then it puts the profit, which you also call as net profit. This may be a profit or a loss. Okay. This profit is recorded in the books of accounts. Or we can say that this is the amount of profit as per the books of accounts. So this profit is therefore termed as accounting profit. If there will be any loss, that will be termed as accounting loss. Understood? Yeah, this one is very simple and easy to understand. Correct? Okay. So now I'll bring in some more terms over. Now, in relation to expenses, there can be various expenses over here. Cost of goods sold, then we can have employee compensation, yeah, depreciation, other expenses. Basis which we compute the profit. So this profit, once again, what do we call it as? Accounting profit. Okay. Have you covered income taxes? Do you have understanding of income taxes? Quickly, you can let me know. Do you have some understanding of income taxes? I'm talking about income tax now. Quickly. Do you have some understanding of income tax? Quickly. Please let me know. Have you covered that? Maybe if you have read this earlier, income taxes. Do you have an understanding of income taxes? It's very important for the purposes of this standard. Kamal is saying little bit. Okay. What about others? Christina is saying that it just started. Till we at graduation level, if you would have read that. Ayush is saying yes, I know income tax. Drishya is saying yes, income tax is known to them. What about others? Shivendra is saying yes, sir. First 3 chapters are covered. Okay, great. Nitya is also knowing some of the basics. Priya is a little bit up. Manish is saying not covered PGP, but have some knowledge. Okay, good. Please remember a couple of things. Now, a couple of things you need to know. First, for the purposes of this accounting standard, your understanding of income tax is important. Because if you don't understand income tax, you will not be able to appreciate this concept quite much. Yeah. Number 2, in this topic, even though your understanding of income tax will be required, but please don't think that you need to be an expert on that. So even if you understand some of the basic concepts, that will help us. Okay, but at least something you should know about income tax. The provisions of income tax you should know, through which you will be able to appreciate it in a better manner. Okay, yeah. Then Jamil, Pallavi, Ayush, they responded. Okay, I think Pallavi has not covered at all. Okay, Pranav is saying we have completed chapter 3. Okay. Nakul is saying I understand the provisions of income tax. Okay, great. So now for your purposes, I'll just keep clarifying the provisions of income tax code. Yeah. Because currently you don't know, so I'll just tell you that this is how a particular item is treated under income tax. So first of all, maybe again some of you may know that depreciation which we compute as per the books of accounts is based on useful life. But the depreciation which the income tax allows, so every year company will have to file the income tax return, or any entity will have to file income tax return, wherein they would start with this accounting profit. Yes or no? Over there, the amount of depreciation which you would have completed as per the books of accounts is not considered. Instead, income tax gives you its own depreciation rates. It's on method of computing depreciation, which is different from the one which you follow on the books of accounts. So we are not going on to that method. Okay, that method we are not getting onto that method. Because of this difference in the method, difference in the rates which the income tax would consider, even though we will start with this profit, the profit on which tax will be computed will be different. Yeah. So let's suppose if I have to put some numbers, let's suppose revenue was 10,000, cost was say 5,000, employee compensation was 1,000, and depreciation was 1. So 7,000 is the cost. So the profit became 3,000. Now what will you do? When you will start computing your income tax, you will start with 3,000. Okay. So 3,000 is what you will start income tax computation. Income tax will say that your profit is after considering depreciation of 1,000. I don't agree with that amount. So what will we do? We will have to add this depreciation. Income tax will say, I don't consider this computation. For me, you need to compute it in a different manner. So we'll have to add this depreciation. This becomes 4,000. Then income tax will say, compute this depreciation as per the provisions of income tax. Let's suppose as per the provisions of income tax, this amount comes out to 2,000. So what is the amount of profit now? 2,000. And you may be thinking, but sir, how is it possible that income tax will be required to be computed on a profit which is lower than the book's profit? The answer is yes. Income tax doesn't ask you to pay tax on more profits as compared to books of accounts or less profits as compared to books of accounts. They have their own methodology, they have their own provisions. So you need to compute as per their provisions. Basis which tax may be lower or higher, it doesn't matter. Fine. It may be lower or higher, it doesn't matter. That's the methodology that we need to follow. Now, let's suppose if we have done that. In this scenario, there is a difference which has got generated. Let's try to understand that difference. There's a difference between the profit which we computed as per the books of accounts and the profit at which tax will be computed. What do we call it as? This profit on which tax will be computed, what do we call it as? Taxable profit. This is called as taxable profit. This can be a loss also. So it may happen that over here we have a profit, over here there is a loss, or here there is a loss and here it may become a profit. Yeah. So it can be any of the scenarios. It is not necessary that at both the places we will have profits or at both the places we will have losses. It can be either. Understood? Yeah. So now there are two terms that we have discussed: accounting profit and taxable profit. We will now get on to an understanding of this difference. There was a difference in the depreciation, correct? So let me just put down that difference over the years. Say we started with an item of PPE of 100. Yeah. As per accounts, let's suppose its life is 10 years. Residual value, let's suppose, is 0. So we have got years. Year 1, year 2, 3, 4, 5, 6, 7, 8, 9, 10. So over a period of 10 years, what will be the amount of depreciation? Can any of you tell me? As per the books of accounts. As per the books of accounts, if the amount of PPE is 100 and the life is 10 years, what will be the depreciation year on year? Consider a residual value of nil. What do you think will be the amount of depreciation year on year? Every year you need to tell me the amount of depreciation. Use SLM, use straight line method and tell me the amount of depreciation. Question is thinks that this will become 10 year on year. This will be 10 in all the years. That's right. Yeah, so every year this amount is 10. Okay, now let's assume I'm not following the exact provision of the income tax, I'm just making an assumption. Let's suppose as per income tax, 20% depreciation is allowed on this item. So depreciation rate is 20%. Okay, and just to keep it simple, I'll pick a full 20%. I'll not go by WD. Okay, just to keep it simple. So in the first year, what will be the amount of depreciation? 20. Second year 20, third year 20, fourth year 20, fifth year again 20. And by the end of fifth year, asset will be fully depreciated. So that means in these years, depreciation will be nil. This is as per tax. Correct? Yeah. Correct on this? Okay. Now, let's try to analyze this. And this is now the most important part of the standard. So I need your attention. In the first year, what do you see? In the first year, we computed our profit as per the books of accounts, taking depreciation of ₹10. But income tax allowed more depreciation. What is the amount of higher depreciation which they allowed? This minus this. So let's suppose this is 1, 2. So the difference is what? So 10 is the difference. On this amount of ₹10, I have paid lower tax in the first year. Is that correct? Yeah. In the first year, what is the implication of this? If you'll see, income tax is allowing more depreciation. So that's why I'm paying lower tax in the first year. Correct? If you go to second year, same thing continues. Next year again, I'll pay lower tax. Why? Because income tax is allowing more depreciation. Same thing is continuing in the third year. Same thing is continuing in the fourth year. Same thing is continuing in the fifth year. So up to 5 years, same thing continues. Okay. Now, I will make a provision for tax. I will make a provision for tax in the first year. That provision for tax will be lower. Why? Where do I make this provision for current tax? Provision for tax is what? Provision for current tax. Where do I make this provision for current tax? This is made in the books of accounts. And provision for current tax will be made based on the taxation of current year on which I have paid lower tax. Why? I have not evaded any tax, but the tax amount came out to be lower as per the provisions of income tax. So that means whatever provision I have created is lower in the first year. So my provision for tax in the first year is lower. Manish is saying more depreciation means low profit and low income tax. That's true. So we are saying provision for tax, or let me just change it now. Let me just say provision for current tax is lower in the first. And I think once again, if you see in second year, third year, fourth year, fifth year, this provision has been lower. Why I'm saying this is lower? Because if I make this comparison of the depreciations computed as per income tax and accounts, then I'm saying it's lower. But let's now move on to sixth year. In the sixth year, I see the trend is now getting reversed. Let's understand how. In the sixth year, in the books, I am claiming a depreciation of 10. But income tax is now not allowing any depreciation to me. They are saying your depreciation amount is nil. They are not allowing any depreciation. So what will happen? Once again, I will get a difference of 10. Once again, I'll get a difference of 10. But in this sixth year, what will be the tax consequence? In this sixth year, I'll be required to pay more tax, higher tax, as compared to what would have been done by me if the depreciation amount was same. Yes? Yes or no? Yeah. So in the sixth year, I'm required to pay more tax, higher tax. So we are paying higher tax in the sixth year. And let's now try to understand why did this situation arise. This 10 excess depreciation, which income tax allowed from year number 1 to 5, is now getting reversed. Can you see this? This is now starting to get reversed from year number 6. Why? Because depreciation is such that whether you consider it in the books of accounts or as per income tax or maybe anywhere else, over a period, over the period of the useful life of the asset or over the period till the time asset is maintained with you, overall amount of depreciation will remain the same. So whether we take books of accounts or whether we take income tax, at both the places, amount of depreciation will remain the same. So the only thing that we have done is that for the purpose of income tax, we have claimed more depreciation in the first 5 years, because of which it will become zero in the next 5 years. Yeah. And because of which we are now starting to see this reverse trend from 6th year onwards. Every year we see that my taxable profit is increased. Every year from 6th year onwards, my taxable profit has increased. And let's now try to understand the implication. In the first year, the tax which I had saved, I'm saying I saved. Why? Because I paid lower tax, is now starting to show a trend from sixth year onwards, wherein I am required to pay that amount of tax which I saved in the first year. So in the sixth year, why am I getting this higher tax amount? Because this much amount of tax was saved by me in the first year. But I can't help it. Why? Because the provisions of income tax are such. So it's not something which I have done intentionally. I have not tried to evade tax. Provisions of income tax don't allow me to claim lower depreciation. So that's because of the problem of the differences in the provisions at two places. Okay. Now, because of this, what should I do? Knowingly. So today, knowingly that there is a difference of ₹10, which will reverse in the future years. Yeah, 10 will reverse in future year. Again, 10 will reverse in future year. Again, 10 will reverse in future year. So today, knowingly that there is a difference which will reverse in the future years, what should I do? On this difference of ₹10, today itself, I should consider a provision for tax. Why? Because I know on this ₹10, I have to pay more tax in the future year. So I should create a provision for tax, which is going to arise in the future year because of this difference which has got generated in the current year itself. But I can't create that provision by calling it as provision for current tax, because income tax law doesn't allow this. So that's why accounting helps us. And this accounting standard 22 helps us by calling that provision for tax for the future years as a deferred tax. So now in the first year, what do I need to do? Over and above provision for current tax, another provision will be created by me in respect of tax on this difference, which will reverse in the future years. On this difference of ₹10, which will reverse in the future years. But now I cannot call this as current tax, because current tax will go as per the provisions of income tax. I will have to call it as deferred tax. And how do we compute this? On this amount of difference, we will apply the tax rate. On this amount of difference, we will apply the tax rate and we will get the deferred tax. Clear on this? Or if you clear on this, if you have any questions, any doubts, please let me know. Because this is the most important part of this content. And I would say this is the base. Ayush is asking if this concept is beneficial to the enterprise. The amount of funds saved in the present due to lower income tax can be invested to earn some interest. Overall, we have to pay ₹100. So why not some interest on it? Why not earn some interest on it? We will however have to pay income tax on the interest on it, which is true. Yes, any questions? In case you have on this, please let me know. Okay, Sakshi is clear on this, Kushi is also clear on this. Okay. So now, in the scenario that we have picked up, we are creating a provision for this deferred tax. And what is this deferred tax? This is going to become a liability in the future years. So that's why we will also call it as a liability in the current year. Yeah. So provision means liability. Provision for current tax, provision for deferred tax. And this provision is shown as an expense in the P&L. It's below the profit line. First of all, you create a provision for current tax, and then you create a provision for deferred tax. So this will be called as deferred tax charge. You will call it as deferred tax charge. Why do we call it as a charge? Because in the scenario that we have discussed, the difference will result into a liability. Okay. This difference of rupees 10 is called as timing difference. This is called as timing difference. So you can say this is a term which is attached, which is called as timing difference. Jamil is saying once again, why deferred tax? Deferred tax because on this rupees 10 you have saved tax today, or you were not required to pay tax today, but because of this difference of rupees 10 which got generated in the current year, you will have to pay tax in the future years. This difference of rupees 10 is reversible in the future years. That's why if you have to complete your accounting, so we follow accounting principles based on accrual concept. Yes or no? So today itself you should accrue this. And how do you accrue? You cannot take it to current tax because the tax provisions don't allow. So how can you do this? By recording it as deferred tax charge, corresponding to which you will book a deferred tax liability. Okay. And this difference is technically termed as timing difference. Why do we call it as a timing difference? Because this will reverse in the future years. Something we have seen. This will reverse in the future years. Okay. Nitya is also clear on this. Very good. So now, let me just change the numbers. Let's suppose instead of books as per tax, we have a depreciation of 10 rupees each year, and as per books, we have a depreciation of rupees 20 each. Okay, so I've just changed the situation. I've sort of swapped these two. Now let's try to understand the situation and comment on this. So first of all, I'll wait for your comments. Now, how do you think the situation will change? And what do you think will be the impact of the same? In the meantime, I'll just try to answer this. Kushi is saying, okay, Kushi has understood this. Kamal is saying, what will happen in case of advanced tax? Nothing. So, advanced tax is something which is different from this. So, let's not mix up these two. Okay, Manish, Jamil, I've understood. Now, the facts have not changed. Okay, I've changed the facts. So, can you tell me, with the changes in the facts, how do you think the situation will change? What do you think should be the accounting treatment now? Yes, I'm waiting for a response now. You need to answer this. Manish is saying more tax has to be paid today itself. That's true. But in terms of the accounting implication, can you comment on this? Ramakrishna is saying it's deferred tax asset. Let me just get some more responses, then I'll go to answer. Christina is saying tax will be higher in the initial years. So what will be the consequence of this? Tax will be higher, more tax will be paid. What will be the consequence on the deferred tax? Do you think deferred tax should be recognized? Do you think there will be any timing difference now? What do you think can now be done by us? Kushi is saying reversal of what we have done will maintain deferred tax as great. So now, books are taking a depreciation of rupees 20, but tax is not allowing that depreciation. Tax is limiting the amount of depreciation to rupees 10, because of which, once again, we see a difference of rupees 10. Okay. And what is it that I am required to do? In the first 5 years, now I am required to pay more tax. My tax liability is higher. My tax liability is higher in the first 5 years. Correct? But let's go to the sixth year. In the sixth year, what will happen? In the sixth year, income tax will allow depreciation, but in the books, I will not have any depreciation. Because of which, my tax liability will start getting reduced from sixth year onwards. So once again, what do we see? A reversal of this difference from sixth year onwards. The only thing is that now we are paying more tax in the initial years, or you can say in the first year. And I know today itself that because of this higher payment of tax, or you can say because of this difference of ₹10 which is generated in the current year itself, I will be required to pay less tax in the future years. Yeah. So if I know that because of a difference today, I will be required to pay less tax in the future years, what should I do? Once again, going by the accrual concept, I should book this. If I'm booking the liability, then I should also book an asset. It's a situation of asset to me because this is going to be a future benefit to me. So future benefit will result into an asset. So I should therefore record an asset in my books of accounts. So instead of deferred tax liability, therefore, what do? I will record deferred tax asset, and corresponding to deferred tax asset, what will I have? I will have deferred tax credit. So instead of charge, I will call it as deferred tax credit. Okay, and which will be a negative number now. Why? Because this provision will be an expense, but this credit will be an income. So in the P&L, when we compute our total expense, what does it comprise of? It will comprise of two items always. One, the provision for current tax, and second, the provision for deferred tax. And this deferred tax could be a charge or a credit. And a summation of these two will be called as total tax expense. Even if this deferred tax will be an income, it will still be shown here. It will not go to revenue in the P&L. No, it will not get added to other income in the P&L. It will keep coming over here as a negative amount. Clear? Yeah? All of you clear on this? So now, because of some differences, which will reverse in the future years, and the differences between accounting and the taxation, which will reverse in the future years, we may be required to create deferred tax. And the deferred tax may be an asset or a liability. Priyanka is saying, sir, why did income tax do this to us? Because unnecessarily we have to get into this accounting standard. Unfortunately, we can't help it. Now, in relation to these differences, there can also be a kind of difference which arises in the current year, but it will never reverse in the future years. Let's try to understand that type of difference. Donation. Let's suppose if we talk about donation. Now, donation is something which will be taken to the books of accounts. So the amount of donation is ₹100. So in the books of accounts, it's ₹100. Now let's try to understand how this donation may be treated as per the income tax. As per income tax, either this donation may be allowed in full or may not be allowed in full, depending on the provisions which are attached, or depending on the benefit which is allowed in relation to a particular donation, because each and every donation is not allowed fully under income tax. Let's suppose income tax allows only 50% of the donation amount. Okay. So I'm just changing it now. So we have a donation. All of those I can take off. So donation as per the accounts, let's suppose is 100. So in the year one, what do we have? 100. But income tax has allowed 50%, only 50%. Now the provisions of income tax are such that whatever is the amount of donation which is allowed, that will be allowed in 1 year only. It will not be allowed every year. Okay. So which means that today we have a difference of rupees 50, no doubt. And because of this difference of rupees 50, our tax liability has increased. So we are paying higher tax. Why? Because income tax is not allowing the depreciation of rupees 50 in the current year, donation of rupees 50 in the current year. Now the question arises whether this difference is reversible in the future years or not. As per the provisions of income tax, this difference is not reversible. Why? Because if they have not allowed 50, they will never allow that in the future years. The provisions are such. There's no logic behind this. That's the provision of the income tax. They will never allow this 50. So can we say that this difference of rupees 50 will ever reverse in the future years? No. This will never reverse in the future years. And something which will never reverse in the future years, can we continue to call it as a timing difference? No. We will call it as a permanent difference. Instead of timing difference, we will call it as a permanent difference. And on the permanent differences, deferred tax is not recognized. So the moment we get to see any item which leads to a permanent difference, this deferred tax will not be recognized. Neither deferred tax asset nor deferred tax liability. None of them will be recognized. Okay. Are you clear on this? See, all of these concepts that we have discussed so far, they become the basis of the standard. So if you have any doubts around any of these concepts, please let me know. And now we will pick up some examples from the study material to discuss this. Quickly, any questions, any doubts in case you have on this? Yes, any questions? Manish is asking, tax on this difference of rupees 50 will be recognized as a loss. No, will not do anything on this difference. It is already there in the books, and nothing from the perspective of deferred tax needs to be done on this. Ramakrishna is saying, in case of donation, we can reverse in accounting books also rupees 50 because of that. No. As per the accounting, the principles are different. Just because it is not allowed in income tax, you can't reverse it because if you paid something, how will you reverse it? Just think of an accounting entry. Where will you record this rupees 50 as otherwise? Not possible. Jamila is asking whether deferred tax asset is shown on the asset side or reversed in the liability side. I'll come to this presentation later on. Ayush is asking, sir, can we also see the opposite? Means we have recorded 50 in the books of accounts, but income tax tells us to record 100 for tax computation. And there's no timing difference. Of course, it may be possible because of any of the provisions of the income tax. For example, if we talk about depreciation on an asset is allowed, say, up to 100% as per the books of accounts. But there are certain provisions of income tax wherein you are allowed to claim depreciation over and above the amount of the asset. Yeah, therein this may arise. So the provision of income tax may go either way. And that's why for you to appreciate this standard, it's very, very important to know the provisions of income tax, because only then you will be able to identify these differences. And only when you identify these differences, you will be able to recognize deferred tax, otherwise not. Pallavi is asking, deferred tax is only on the timing differences? Yes. Only on the timing differences you will recognize deferred tax. It can be a deferred tax asset or a liability. But on the permanent differences, you will not require a deferred tax asset. Sorry, deferred tax asset or a liability. Okay. So then I think we can move on to illustration number 1. This is page number 1.112. And this one needs to be solved by you. Very simple illustration. And this is also based on similar sort of concept we have discussed. So you can start solving this and let me know the answer. Rama Limited has provided the following information. Depreciation as per the books, 2 lakh, as per the tax, 5 lakh, unamortized preliminary expenses as per the tax, 30,000. So as per the tax, there are unamortized preliminary expenses, which will not be there in the books. There is adequate evidence of future profit sufficiency. So they are saying in the future profits will be there. How much deferred tax asset or liability should be recognized when the tax rate is 15%? Okay, quickly. I'll just wait for the response. I'm sure some of you would have already solved this. Yes, quickly. Tell me, what will be the amount of deferred tax asset or a liability in this scenario? Okay, so then we can go to the solution. First of all, we will check the depreciation differences. So as per the books, it is 2 lakh, as per tax, it is 5 lakh. So first item is depreciation. And then we'll see what's the difference. So in terms of depreciation, we see a difference of 3 lakh. 5 lakh less 2 lakh. Now the question arises whether this difference is a timing difference or not. Tell me quickly, do you think it's a timing difference? In respect of depreciation, is it a timing difference? I think some of you have already saw this. Sakshi is saying deferred tax liability is 1,50,000 and the asset is 15,000. Net is BTL of 1,35,000. Shabir has got the same answer. Atul has computed a liability of 1.5 lakh. Manish has computed DTA of rupees 1,50,000. Nitya has computed DTL, putting net of 135. The transition adjustment means the adjustment on the transition rate. For your purposes, currently, you will just ignore this. Very simply, you can say you are required to compute this. Okay, so now this difference is definitely reversible. Why? Because it's on depreciation, and depreciation is something which over the period will show a reversing trend. So that's why, yes, it's a timing difference. So the moment we say it's a timing difference, we need to compute the deferred tax. So what's the tax rate? 50%. And what's the amount of deferred tax? Deferred tax will be 3 lakh into 50%. 3 lakh into 50%. So we get 1,15,000. Now the question arises whether it will be a DTA or a DTL. DTA or DTL means whether it will be deferred tax asset or a deferred tax liability. So let's analyze this. As per the books, depreciation is 2 lakh. As per tax, depreciation is 5 lakh. So tax has allowed more depreciation in the current year. Means I have paid lower tax in the current year. So that means in the future years, tax liability will increase. I will be required to pay more tax in the future years. So therefore, what would this 150 become? This would become DTL. This would become DTL. Okay. I think Pallavi also computed the same amount. Very. Priyanka is saying 3 lakh is the 10. Now the next item is unamortized primary expenses. Unamortized primary expenses. Now, as per the tax, it is 30,000, but as per the books, it's nil. So there's a difference of 30,000. Yeah, there's a difference of 30,000. Now the question arises whether it will be a timing difference or not. See, in the books, we don't have any concept of deferment of this amortization of primary expense. This would have got charged off whenever this would have got arisen. But income taxes amortizing it over the period. So anyways, over the period, this will reverse. This will become zero. So definitely it's a timing difference. So the answer is yes, it's a timing difference. So if it's a timing difference, we need to compute the deferred tax 50%. So 30,000 into 50%, what do we get? 15,000. Now the question arises whether this 15,000 will be a deferred tax asset or a liability. So let's analyze this one again. In the books, what would have happened whenever preliminary expenses would have been incurred, entire amount would have been booked as an expense. That's why it's nil. In the books, we charged off 100% amount. But tax didn't allow this entire amount of expense at that point of time. Tax said that I will allow this expense over the period, which is now getting allowed over the period. So that means I would have paid more tax when this expense was incurred, and because of which I will be required to pay less tax in the future years. So that's why what would it become? DPA. So therefore, what do we have? We have one item which is resulting into DPL and the other item which is resulting into DPA. Now, in the exam, whenever you are required to compute this, you should always present your computation of each and every item separately, the way it's done over here, and the way it's done in the study material also. But in the balance sheet, set of principal is required to be aligned. Set off means you will set off two items, means one is a liability, second is an asset, if they are allowed to be legally set off. And legally, when can those be set off? Legally, those can be set off when they belong to the same jurisdiction. Now, we are talking about a company in this case. A company will be subject to one tax jurisdiction only, and the tax provisions that we are discussing over here, those will also be allowed. So that's why it will be appropriate to consider this setup. And the moment we say these are allowed to be set up, what would it become? On a net basis, we have 150 liability and 15,000 assets. So this will become 1,35,000 as DTL. And this DTL, you will not say it's a DTL, you will say net. This is net. Why it is net? Because this is net of deferred tax asset. So this word net, you will have to use alone. And this is how you will present it in the balance sheet. So in the balance sheet, in the standalone financial statements, you may either have net DTL or net deferred tax asset. Okay. Ramakrishna is asking, sir, can we again discuss this DTL of preliminary expense? Sure. See, preliminary expense was allowed fully in the first year in the books. Entire amount is full year. 30,000 fully taken to books and expense became and fully expensed. But income tax didn't allow 30,000. 30,000 was not allowed by income tax. They said we will allow it in the future years over the period. So that's why we got this difference. In the first year, when this entire amount was booked in the books, but income tax didn't allow, what would have happened? I would have paid more tax, but in the future years, I will not be paying the tax. I will be paying less tax. So that's a benefit to me. That's why it becomes DT. Okay. Clear? Kushi, since the tax rate is 60%, will make DT of 40% or 60%. See, whatever is the tax rate, that will be the amount of deferred tax. Simply, you need to multiply the timing difference, this amount of timing difference, with the tax rate. Whatever is the amount, that is your deferred tax. And then you need to also analyze it, whether it will be a deferred tax asset or a liability. Mr. Sorry. Yeah, Ayush is saying, so we could have recorded as DTA at that time and not now. No. So this DTA you are recording today. Krishna, I'm hoping you are clear on this. Yeah. Okay. So if you have any more questions, any more doubts, please let me know. Okay, Khushi seems to be clear on this. Very good. So then I think before we go for a break, we can pick up another example, another illustration we can pick up. We can pick up illustration number 2 now. Okay, so let's go to illustration number 2. And this is page 1.113. From the following details of A Limited for the year ended 31st March X1, calculate the amount of deferred tax asset or deferred tax liability as per AS22 and amount of tax to be debited to P&L for that year. So the information is accounting profit is given to us, book profit as per that is given to us, profit as per Income Tax Act is given to us, tax rate is given, MAT rate is given. Yeah. So in this case, we are required to compute deferred tax asset or the deferred tax liability. Pallavi is asking, sir, what will decide? We can, of course, we can set up DTA, DTA. Now here again, some of the provisions of income tax are required to be understood. And that is about computation of tax. And I'll not get into too much technicality of those provisions. I'll just quickly touch upon the concept because this standard will require various provisions of income tax to be understood and then applied. Only then you will get better clarity around any of the principles of the standard. First, I'm talking about books. In the books, as we have discussed, tax expense is shown. In fact, I have presented the dates given in the P&L. So if you go to the P&L, what do you have? The revenue, X amount, then expenses. Then we have net profit before tax. Correct? From this, what is it that we are required to reduce? Taxes. So we reduce tax expense. Yeah, we are required to reduce tax expense. This tax expense comprises of two things: current tax and deferred tax. And then we get back profit after tax. Okay. Now this is something which is important for solving this illustration number 2. What is the tax expense in the books of accounts? Current tax and the deferred tax. Now this deferred tax can be a charge or a credit. If this will be a charge, this will be positive number. If this will be a credit, this will be a negative number. But summation of these two will be the total tax expense, which will go to P&L. Clear? Number 1. Number 2. Now I am talking about the provisions of income tax. I am not talking about accounting right now. Now I'm talking about provisions of income tax. Just give me 1 minute. As per the income tax, for the purposes of computation of tax, I'm saying for the purpose of computation of income tax, there are two provisions. So when I'm saying provision for tax, there are two provisions. One, which is called as normal provision. Normal provision means compute the taxable profit and take the rate of tax and compute the income tax, which I am saying is normal provision for computation of tax. There is another provision which is applied as per income tax, wherein certain companies which do not have much profits or which are into losses, they at times are also required to compute their tax as per a different provision. So one is a normal provision, you can say a second provision, which is called as MAT, minimum alternate tax, basis which they need to compute their tax. So for the purposes of computation of tax, what do they need? Book profits. And these book profits are not the one which you will see over here. No, this is not the one which you will see over here. This book profit has a different formula as per income tax provisions. And we don't need to get into that formula because we are not discussing income tax today, we are discussing accounting. And on this book profit, you will apply the rate of MAT. So you will get some tax amount. You will get some tax amount. Income tax says if the tax as per MAT, let's suppose comes out to 10, and income tax as per normal provisions comes out to say 7, then you are required to pay 10 and not 7. Okay, yeah. So that means if the MAT provisions result into higher tax, you will have to pay higher tax. But as I told you, this has got nothing to do with books. This is all about computation of tax liability. So for computation of tax liability, two provisions are there in income tax: normal provisions and MAT provisions. Fine? Yeah. So this is something which you wanted to know, which you should have known for us to solve this illustration. Okay. So now I'll get on to this illustration. Okay, so now we have got accounting profit as 6 lakhs. So if we compute tax as per accounting profit, we will say it's 6 lakhs into 20%, 1 lakh 20. 20% we are applying the normal. Okay. And tax as per income tax, as per taxable profits. What's the taxable profit? 60,000. So 60,000 into 20%, so we get 12,000. Then we are also given MAT. So tax as per MAT. Book profits for the purpose of MAT, 3,50,000. And MAT has a different tax rate, 7.5%, which comes out to 26,250. So now for this year, what is the amount of tax which this company will be required to pay? 26,250. Okay. Sushil is asking, sir, what is MAT? As I told you, this is not an income tax class going on, so that's why let's not get into this technicality. Very simply, you can say it's a method of computing tax. Yeah. Now, we are given only this much information for us to compute the deferred tax. So now we don't have to do this comparison of differences or the computation of timing differences because the information is not available. Okay. So that's why, how do we compute it? You will have to follow the approach of tax expense. So what is my tax expense? We understand that is current tax plus deferred tax. Tax expense for us is 1,20,000. Tax expense has to be 1,20,000. And what should be the amount of current tax? Current tax should be 12,000 plus deferred tax. So with this, can we compute the amount of deferred tax? Yes. Deferred tax comes out to be 1,08,000. Very simply. Yeah, deferred tax comes out to 1,08,000. Now, deferred tax has been computed by us, but the question requires amount of tax to be debited to P&L for the year is required to be computed. Okay, so let's understand the amount of tax to be debited to P&L. Tax to be debited to P&L for this year ended. Okay. So what do we have in terms of tax to be debited for the P&L? Current tax plus deferred tax expense. Okay, we have deferred tax expense over here because it's a liability, correct? Plus excess of MAT over current tax. Excess of MAT over current tax. Why? Because for the purposes of current tax, if the MAT will be higher, then we will have to pay higher tax. We will not be limited by the current tax amount, which seems to be the case over here. So we have 12,000 over here plus 1,08,000 over here plus excess of MAT over current tax is what? 26,250 minus 12,000. Okay, so 26,250 minus 12,000. So this seems to be the total amount which should go to the P&L. So in the P&L, therefore, what will we have? 1,34,002, and this will be the total tax expense for the year ended 31st March X1. Okay, I think Shabir has already computed this. Very good. Jameel is asking, sir, MAT or normal, whichever is higher, we have to pay. Yes. Whichever is higher, we have to pay. This is as per the provisions of income tax. Accounting has nothing to do with this. Accounting is just simply recording the same. So if you can just simply see, I can also cut it down over here. I can say instead of current tax, I write MAT plus deferred tax. Why? Because I know MAT is higher. So that's why, what do I write? I'll write 26,250 plus 1,08,000. I'll get the same answer. Yeah. So either way, you can understand this. Pallavi is saying, do we look for conditions before we set off? Of course, yes. But you will not be required to get into too much technicality for the purposes of your questions at this level. You will just simply set it up. And this information also will not be available to you. So don't worry about it. As a principle, you need to know this. Okay. Yeah. So with this, I think we've already stretched our session quite a bit and you will be waiting for the break. So let's take a break of 5 to 10 minutes. And after the break, we will continue with our discussion by solving some more questions on this statement. Okay. In the meantime, if you've got any query, you can just send your query and after the break, we'll start with your queries. Kamal is asking, sir, what if MAT is lesser than the current tax? Then you will go with the amount of current tax. Because over here, this will become 0. Yeah. So let's take a break now. Hi, welcome back. So we can now continue that discussion. Yeah. Sorry, I didn't see any queries. Nitya is very clear on this concept. Great. So now we will pick up one more illustration. Yeah. We can move on to illustration number 3. Idea is to again discuss some more concepts. And in relation to this illustration number 3, let us just get into the concept wherein we have got losses. Business losses or depreciation which is carried forward. As per the provisions of income tax, if there is a business loss in a particular year, okay, you will not be required to pay tax, but tax provisions allow you to carry forward that loss in the future years. So let's suppose in the next year you have got business profit. So you can bring in your business loss of the last year, set it off against the current year's profit, because of which your current year's profit may become zero in terms of computing the taxable profit. This is allowed as per income tax. And same way, if there is some depreciation in relation to the losses of the past years which could get adjusted, that is allowed to be adjusted in the future years, basis which you may not pay tax in the future years, or you may pay lower tax in the future years. Why? Because your taxable profit may go down in the future years. But for this business loss to be adjusted in the future years, what do you need? You need future profits. If you will continue to have losses in the future years, then you will just keep accumulating the losses. You will not be able to adjust it. Correct? Now, if you look at this business loss which is carried forward, this is something which would exist as per income tax. This is something which would exist as per the income tax. Because in the books, it is already recorded. In the books, we already have a loss which is recorded. Yeah. So that's why here again we have a timing difference. Why? Because in the books, whatever is the loss, that is already recorded. But in the future years, tax will allow that loss till the time it doesn't become zero. And because of which I will be paying lower tax or nil tax in the future years. So that's a benefit to me. Yes or no? So that's why, what would it result into? It would result into deferred tax asset. So the standard says that in respect of business losses that we have, we can recognize deferred tax asset, or you can say unadjusted business losses that we have, we can recognize deferred tax asset. But let's try to analyze this situation. By recognizing deferred tax asset, what do we mean? What will be the accounting entry? We will say deferred tax asset debit to deferred tax credit. Say 100 or 100. So in a way, you are recording an income. By recognizing deferred tax asset, in a way you are recording an income. Even though this income will be adjusted against the tax expense, but it's an income only. So standard says a business which is incurring losses will end up booking an income. Why? Because of getting business losses. It's not appropriate till the time the business is not sure that in the future years it will generate profits, against which these losses can be adjusted, or you can say against which this DTA will get adjusted, because DTA will have to reverse in the future years. Yes or no? So for this, standard is very stringent, and standard says till the time we don't have virtual certainty supported with convincing evidence, we should not recognize this DTA. So even though DTA is something which is required to be recognized, till what time we will not be able to recognize this? Till the time we don't have virtual certainty as around the profits of the future years. And for this virtual certainty, we should have convincing evidence in place. There should be signed contracts in place, basis which we understand that these business losses will get adjusted with the future profits. Only and only then this DTA can be recognized. And please understand that this DTA is only about the DTA on business losses. We are not talking about all DTAs to have virtual certainty supported with convincing evidence. We are only talking about DTA on unadjusted business losses. Okay. Yeah. Pallavi has a query. Pallavi is saying, I think this was in relation to the previous one. Since the current tax is higher than income tax, current tax is the books tax. Yes, of course. Atul is saying in the last illustration, deferred tax we calculated to know it's a liability or asset. Yes, to know it's a liability or asset. We wanted to compute the deferred tax expense, only then we were able to compute the total tax expense. He's saying, should we compare tax as per the income tax profit and tax as per MAT? See, both are required to be compared, and the same thing we did. Okay. Yes, any more questions? No. So now this is again a very important concept, and the last illustration which we did, this illustration number 2, you'll see in the past years this has repeatedly been asked in the exam as it is. Yeah. So this standard is quite important, and this is not only important theoretically, as I told you, it is also important practically. And practically, if you look at the current scenario, this appears to be one of the most dreaded standards. Yeah, there are a lot of challenges, there are a lot of struggles in terms of computation of deferred tax, so that's why a thorough understanding of this concept is very important. So let's move on to the next illustration, number 3, page 1.114. Yeah. PQR's accounting year ends on 31st March. So we are looking at financial year. Company made a loss of 2 lakh for the year ending 31st March X1. So 31st March X1, there's a loss 2 lakh. It's a loss, so I'm just making it negative. It's a loss. For the years 31st March, ending 31st March X2, X3, it made profits of 1 lakh and 1,20,000 respectively. 1st March X2, 1 lakh was the profit. 1st March X3, 1,20,000 was the profit. It is assumed that the loss of an year can be carried forward for 8 years and tax rate is 40%. By the end of 31st March X1, the company feels there will be sufficient taxable income in the future years against which carry forward loss can be set off. There is no difference between taxable income and accounting income except the carry forward loss which is allowed to be set off in the future years. Prepare a statement of P&L for the years ending 31st March X1, X2 and X3. I think a very easy one. Can you start solving this on your own? Yeah, can you start solving this on your own quickly? Pallavi, I think if you have got any more queries in relation to illustration 2, let's park it towards the end of the session, please. Let's focus on this illustration number 3 now. And can you all start solving this on your own? Okay, Kamal has a query. Kamal is thinking, suppose in the future, it will be a loss for business, so can we recognize DTL? See, if it's a loss in the future years, and today also we have a loss, then we are looking at a scenario wherein, because of this today's loss, can we recognize DTA? You are talking about a situation wherein today there is a profit on which tax etc. has been paid in the normal course. And you are assuming in the future there will be a loss. So if in the future there will be a loss, why do you think it will result into a deferred tax liability? What's the rationale? Because if there will be loss in the future years, that doesn't mean you have paid higher tax liability today. Or sorry, lower tax liability today, which you are required to pay more in the future years. Okay, let's think about it. Ayush is saying, sir, we should pay tax only on 20. I think you are still stuck on this illustration number 2. I would request all of you to please stop sending your queries because there's only creating a confusion. Yeah, let's focus on this illustration number 3 now. Okay, so now moving on to this P&L, statement of profit and loss for the 3 years. 1st March X3, 1st March X2, 1st March X1. So year on year we are given profits or losses. So here we have a loss, here we have a profit, here again we have a profit. Okay, on which we will compute current tax less current tax at the rate 40%. In the first year, there will not be any current tax. Why? Because it's a loss. Okay. But because of this loss, which can be set off in the future years, we will get a timing difference in relation to which we can recognize a DTA. Yeah. So we will get a deferred tax in the first year. What's the deferred tax? This 2 lakh into 40%. This is 80,000. And this 80,000 is a credit. Please understand, this 80,000 is a deferred tax credit. It's a DTA. So if I have to take this figure as negative, what would it become? It's a loss. So that's why from the loss, I'll reduce the profit or this income. So the amount that we get for the profit or loss profit or loss after tax. This will be that. Correct? Yeah. Now let's move on to the next year. In the next year, what will happen? This 1,20,000 of loss, or you can say this 2 lakh of the loss will get adjusted over here. Sorry, this is not 1,20,000. Sorry, this 2 lakh of the loss will get adjusted. Why? Because as per the tax, what's the loss amount? 2 lakh. So next year, profit is 1 lakh and 2 lakh will be the loss. So net once again there is a loss of 1 lakh. So will there be any current tax liability in the next year? Once again, no. But in the next year, deferred tax asset to be recognized will have to be checked, because we already have a deferred tax asset on 2 lakh. But out of this 2 lakh, 1 lakh has already got adjusted. Out of this 2 lakh, 1 lakh has already got adjusted. So what are we left now? 1 lakh. Or you can say, on this 1 lakh, which has got adjusted over here and on which we have not paid the current tax, what should we do? We should reverse that. So on this 1 lakh, 40% of the deferred tax asset will get reversed. So this will get reversed because we fully recognized it over here. So in the next year, what will happen? This deferred tax will get reversed. Eventually, this has to reverse in the future years. This will get reversed. As a result of which, what will happen? We will show 60,000 as the profit in the period. Okay. Now let's move on to the next year. Next year, what is the amount of business loss which is carried forward? 1 lakh. So out of 1,20,000, 1 lakh loss will be adjusted. What are we left with? We are left with 20,000. On 20,000, we need to pay the current tax. So on 20,000, we will pay the current tax. So 8,000 will be the amount of current tax in the third year. And out of this 2 lakh, 1 lakh got reversed over here, and 1 lakh has also got reversed over here. So this 40,000 is once again reversed. So what is the total position of the P&L in the third year? 72,000. Understood? Clear on this? So I can see some of the responses from your side also. Manish was saying, sir, 8,000 will be debited to the P&L in the third year. I think you were talking about this amount. Then Shabir is saying, PAT for the year X1 is 1,20,000. For X1 is negative 120. Very good. For X2 was 60,000 profit. Very good. For X3, okay, Shabir got the answer correctly. Very good. Ramakrishna is asking, sir, if the losses are accumulating and carry forwarding in the books and in near future also, we keep incurring the losses. So do we create DTA? No. Jamil is saying that deferred tax part is not clear. 80,000 asset, 40,000 asset. So Jamil is saying, sir, how did you compute this deferred tax? It's very simple, Jamil. This 2 lakh is the loss which you will carry forward in the future years. And please understand the impact. When you will carry forward in the future years, will you pay tax? Can you see? We didn't pay tax in the next year. And we didn't pay tax in the next year. So we saved tax. Why? Because of this loss. So that's why on this loss, what do? You will recognize deferred tax asset. Clear? Number one. Number two, in the next year, when the deferred tax asset which you had recognized amounted to 80,000, against which you have already availed the benefit. So can we just continue to keep it at 80,000? No. This has to go down. Why? Because this is something against which adjustment has been made in this second year. So that's why you are reversing it by 1 lakh. Okay. Then once again you are reversing it by 1 lakh. Clear? Clear on this? Yeah? Any more doubts? Any more questions in case you have? Tell me quickly if you've got any more questions, any more doubts. So I'm just marking illustration number 4 for your homework. Your homework is illustration number 4. Okay. So any more questions on this? If you have any more questions, please let me know. Okay, Jamil is clear on this now. Very good. I'm just hoping this concept is understood clearly to all of you. See, deferred tax, if you understand, will become very easy for you. Otherwise, this will become extremely difficult. This is not something which will lie in between. This is what I've seen. Okay, so that's why it's important that you revise it after this session. And this standard, you'll see its application everywhere, every entity. So practically, you will find it difficult otherwise to apply this. Okay. All of you clear on this? So if you are clear on this, then I think we can move on to the next topic. Khushi is also clear on this. Ramakrishna is asking, sir, could you please give some important notes so that it's easy to remember? See, all of these discussions that I have been doing, I'm just trying to create summaries for you. Okay, so as regards the notes, I would say the notes are already available in form of detailed notes in the study material, which you can read. But for the purposes of your examination, you will need summaries, short notes. Wherein some of these short notes which I have been creating, or maybe these pictorial presentations I have been doing, this will help you to just quickly revise. And you can add to this on your own. Any of the points which you want to understand in more detail, you can just mark a reference for the same in the study material or add to your notes. I think that would help you. And that is what you should really look for. Okay, so then I think Aditya is also clear on this, and Aditya is finding this approach good. Very good, Aditya. Ramakrishna is saying, sir, if in the first year loss and second and third year there's a profit, we have to create DTA in the first year, and in the second year we are setting off or reversing like this. So maybe, whatever you have written, you can write it in your own words. That should help you, and in fact that will help you in a better manner. Okay, and please note down the homework, and can you all please quickly confirm that this homework which I have been giving you in the every session, are you doing this? Yeah. So Sheila is asking, let's say, please solve this illustration number 4. This is your homework. Huh? If you find any challenge in this, we will definitely solve this in the next session. This is your homework. It's based on the same principles that we have discussed. There's no new concept which is going to arise over here. Okay. Can you quickly confirm before I move further about the status of homework? Are you regular in completing your homework? Yes, we will move on to the next topic, but I'll just wait for a response. Homework you have been doing? Tell me quickly. Okay, Nakul has understood this, and I think Khushi, Sakshi, Manish, Nitya, they have confirmed they are doing the homework. Very good. Atul has completed the homework. Shabir and Aditya have also completed. Okay, Aditya has also completed illustration number 4 of the homework, which is again good. Then I think Khushi has been revising this regularly. Very good. Ayushi Singh are not doing the homework, but will do from now onwards. It's very important. And as I told you, it's not only the homework. See, homework is the minimum number of questions which you need to do. Other than this, as I told you, there are certain questions which are given towards the end of the material in terms of testing your knowledge. Then there are questions which we have been solving in the session. All of these questions you should practice on your own. Maybe after revising the concept once again or without revising, whichever way you feel comfortable. That will be your real practice. And that is very important, because without that, if you are thinking you are ready, you are not ready. Okay, that's extremely important. Jamil is also doing the homework. Okay, so now we will move on to the next concept, a very interesting concept, AS19, which is on leases. So let us first of all understand about the meaning of lease. Then we'll also understand some of the terms which will be applied in this standard. Because today I don't think we'll be able to get into too much aspect of this standard. So we'll touch upon some of the concepts only. And in terms of the computations, etc., which is involved, we'll be able to take up in the next session only. So let's understand, what do you mean by a lease? Lease means an agreement whereby one party, say, if we have got two parties, yeah, Sakshi Limited, yeah, and we have got another party, say, company Jamil Limited. Okay. Now, Sakshi Limited has given a car to this company on lease. Car is given to this company on lease. What does it mean? That this company is given the right to use this car. And right to use this car, let's suppose, is for a period of 3 years. Okay. Now, in return for this right to use the car, Jamil Limited will make the payment to Sakshi Limited And this payment can be an annual payment, monthly payment, so it can be either way. So this can be a single payment or a series of payments. So we can say a single payment could be made or series of payments could be made. Yeah. Now, the most important thing which is required to be understood is the right to use. Right to use. In this arrangement, Sakshi Limited, even though has given the possession of the car to Jameel Limited, the ownership continues to lie with Sakshi Limited. Ownership has not been transferred. Ownership continues to be with Sakshi Limited. Possession may be with Jameel Limited, and of course, it will be there with Jameel Limited for at least some time. And Jameel Limited will only be allowed to use this car. And after completion of 3 years, Jameel Limited will not be able to use this car at all. Okay, that is where this arrangement ends. Another example you can say, let's suppose we go and take a property on lease, property on rent. What do we call it as? Lease arrangement. Now in this case, this party which has given the asset to the other party for use is called as lessor. This party is called as lessor. And the party who has got the asset and the right to use that asset is called as lessee. So who is the lessor? Lessor means the owner of the asset. You can also say owner of the asset. And who is the lessee? Lessee means the party who will be using the asset. Yeah. This term of 3 years, over which this arrangement will continue, is called as lease term. This is called as lease term, because this is the period over which this agreement will work. After this agreement will come to an end. Okay. The payment or the series of payments which Jameel Limited will make to Sakshi Limited is called as lease payment. These payments are called as lease payments. Okay. And this car for which the right to use has been transferred or given to Jameel Limited is called as asset under lease. This is the asset under lease. Understood some of these terms? Yeah. Now, there are a few more things which we need to understand. First is about this lease term. What is going to be the lease term? Lease term means that term which is non-cancelable. Let's suppose these two parties have entered into a contract for 3 years, but the contract says that after 2 years, either party can terminate the contract without paying any termination penalty, but after giving a notice of 1 month. So that means after the end of 2 years, either party can terminate the contract by giving a notice of 1 month. So in this case, what do you think will be the non-cancelable term or the lock-in period Lock-in period is 2 years plus 1 month. Because 1 month notice is also mandatory. So 2 years, 1 month is the lock-in period. Correct? So in this case, we are saying 2 years, 1 month is the lock-in period. This is the lock-in period. Now, as per the requirements of the standard, what would be the lease term? Lease term will not be 3 years. Lease term is the term which is non-cancelable. Okay, so therefore, for the purposes of AS 19, what would become the lease term? This would become the lease term instead of this. Okay, clear? Number 2, all of these things or this entire assessment that we have been discussing, this needs to be done at the time of entering into this contract. Means whenever two parties enter into this contract, they need to analyze this, which is also called as inception of the lease. Means entire assessment that we will do in respect of this standard will be at the time of inception of the lease. Inception of the lease means the day when these two parties have entered into a contract. Okay, clear? Clear with these terms? Yeah. Now there are few things which I will clarify. Though this is automatically clear, but I will clarify. Lease payments will always be made by whom? Lessee to the lessor. Can there be a situation wherein the lessor makes the lease payment to the lessee? No. It will always be from lessee to the lessor. Ownership of this asset should always be with the lessor. In no situation, ownership can shift to the lessee. Ownership should stay with the lessor throughout the period of this arrangement. Otherwise, this will not remain a lease. Clear? Clear on this part? Yeah. So if you have got any questions, any doubts around any of these terms, please let me know. And you should also note down all of these terms. These terms, if you want to understand with the definitions, you can refer page number 1.70. Okay, yeah. If you've got any questions, please let me know. As now many of these terms, if you need any clarity, please let me know, because we will conclude our discussion over here. We will not be continuing on this any further. But please remember, in the next session when we will start with understanding of all of these terms. So that's why it's very, very important that in the next session when we meet, you make sure that you understand all of these points. Okay? Yeah? These are the terms which will be repeatedly used for the standard. So you can say it's the base. Yes, any questions, any doubts in case you have on this? Okay, Aditya is saying, would you be starting with AS 19 again? No. So I'll be continuing with this. Kushi is clear on this. Manish is saying, sir, why 1 month extra? No, that's the notice period. Without that, termination cannot happen. That's all. Ayush is saying, sir, can we have third party payer or pay? No. No, there are only two parties which are involved. Priya is saying, sir, clarity on the lock-in period. Lock-in period means during this period, two parties are stuck. They cannot cancel this contract. First, 2 years is the minimum period for which they need to have this agreement. And after completing 2 years, 1 month's notice has to be given. So this is a lock-in period. Means this much period has to be served. Without this period, contract cannot be cancelled. Jamil is asking who will charge depreciation. See, all of these are the accounting norms on which we'll move in the next session. Shabir is asking, sir, after giving asset on lease, lessee made any expense on that asset, lessor is liable to pay them back or is borne by the lessee. That depends on the type of arrangement they will have. Okay. Atul is asking, sir, once more, please explain the lease term. Lease term means the term which is non-cancelable. So in our example, the term was 3 years, but after 2 years, the contract can be cancelled, terminated by giving 1 month's notice. So that's why what's the non-cancelable term? 2 years and 1 month. Okay. Priyanka is asking, sir, notice period will be same for all the leases? No, that depends on the arrangement between the two parties. It's not really a term which is fixed. This is only an example I have used. Notice period can be 15 days, can be 3 months, can be 2 months. It varies. That depends on the terms between the two parties. Okay. Yeah. Priya is clear on this. Very good. So with this, we can then end our discussion. Thanks to all of you once again for your time and for your wonderful participation again. And please make sure that in the next session when we meet, you come with the revision of at least these parts. Okay. Thanks so much.